So I'll be talking about yield curve and inverted yield curve in a very layman language. But before starting with yield curve, let me explain what yield is first. So yield is basically the returns that investors are expecting from particular bond or particular debt instrument. Here, yield is a very vague statement. It's not explaining if it's current yield or YTM yield. It's just the returns. It's like salary. If I'm saying my salary is X amount, I'm not stating if it's gross salary or it's net salary. Similarly, yield here is not stating if it's YTM or current yield. What is current yield? Current yield is basically the coupon payments that you are receiving, annualized coupon payments upon the bond price. So example, if the coupon payments that a particular bond is giving is $30 and its current bond price is $300, that means that the current yield is 10%. At the same time, YTM yield to market also considers the compounding effect plus the effect that you might have bought that particular instrument at discount or at premium and you'll sell that instrument at a particular par value, so you'll gain or loss from that particular thing as well. So that is YTM considers everything, the return that a particular investor will earn if he holds the particular bond throughout the maturity. Now coming to yield curve here we have on the horizontal axis maturity and on the vertical axis we have yield. So with time the yield increases. That means for the long term bonds the yield is higher compared to the short term bonds where the yield is lower, and it makes sense because imagine me giving or lending money to my friend for 3 days. I won't charge him with a lot of interest, but if I'm giving him money for 3 years or 4 years, I'll charge him with higher interest. Why? What if his conditions, his financial conditions deteriorates with time? I don't know. I know that in 3 days his financial condition won't deteriorate that much, but it can get worse in 2 or 3 years. That's why I'll charge him with more interest. And generally, this is how the yield curve looks. But sometimes we also have inverted yield curve, and it has been noticed that since 1960, before every recession, investors could observe this pattern, inverted yield curve. Inverted yield curve explains that the interest rates for short-term bonds is comparatively higher compared to interest rates for longer-term bond. That means that the investors anticipate that with time the condition might improve, but for a short period of time, or for this condition for at present, and for shorter duration bonds the market condition is not good and the investors are anticipating a recession or economic slowdown. How does this affect valuation of companies? Now, since investors are anticipating an economic slowdown, that means that the cost of borrowing for companies will increase. Companies will have to pay much higher interest if they want to borrow money today because the economic condition of the market is not good. And since when we are valuing the companies, we put the denominators as cost of borrowings and numerators as cash flows. So as denominator increases, the whole value of the company decreases. So this might affect the valuation of the company as well. And this is a very important tool that investors can use to predict economic slowdown and recessions.